Nasdaq hits a fresh record high, but risk is quietly building. Over the past 5 trading sessions, overall sentiment in the Nasdaq has clearly improved, with both candle highs and lows showing a steady upward progression, indicating sustained accumulation by the bulls. On August 8th, the index successfully broke above the previous high of 23,589 and set a new all-time high at 23,611. This move itself constitutes a bullish breakout signal on the technical front. As we highlighted in our previous commentary, once the bulls effectively hold above the MA10, the market is positioned for further upside. A scenario that has played out in line with our expectations during this latest rally phase. Breaking down this week's price action, several key details stand out. First, between August 4th and August 6th, both price and volume rose steadily in tandem, forming a healthy price-volume rise structure. This not only indicates renewed capital inflows but also builds the necessary momentum for the subsequent breakout. Second, on August 7th, the market continued to expand in volume. However, the daily candle displayed long upper and lower wicks. This was particularly notable as prices approached the previous high at 23,589, where the market showed clear signs of divergence. This reflects an active battle between bulls and bears near a key resistance level, with some funds choosing to take profits in this zone. Third, on August 8th, the market decisively broke above the prior high and set a new record, confirming bullish dominance from a technical perspective. However, it is worth noting that volume on the day was slightly lower than the previous session. This suggests that, while the bulls have gained the upper hand, the enthusiasm for chasing prices higher has not accelerated further. Instead, some participants appear to be adopting a wait-and-see stance, showing caution at elevated levels. From a swing perspective, the angle of ascent in this rally, which began after filling the downside gap, is clearly steeper than the upward channel seen in July, reflecting a short-term acceleration in bullish momentum. However, the RSI has not reached a new high in tandem with price. In fact, it has edged slightly lower. This price making new highs without matching momentum constitutes a mild negative divergence sign, hinting that the pace of gains may slow in the short term. The performance of the industrial average also needs to be considered in the overall assessment. Since the start of August, the Dow Jones has not, like the Nasdaq, set new highs, and it remains within a secondary corrective phase, with price action showing a relatively weak, choppy structure. On August 7th, market divergence was significant, with pronounced signs of profit-taking at the highs, reflecting investor caution in the current range. More notably, the August 8th daily candle formed a classic and sidebar pattern relative to the prior session, signaling short-term consolidation as the market awaits a directional breakout. The breakout direction of this pattern will be key in determining the Dow Jones's trajectory next week. An upside break could help blue-chip stocks recover and narrow the performance gap with the Nasdaq, while a downside break would likely extend the secondary correction and weigh on overall market sentiment. Beyond technical signals, the macro environment this week also provided important context for market movements. From a fundamental perspective, the U.S. economy presented a mixed picture of resilience plus labor market softness plus easing inflation. Second quarter GDP and PCE inflation both exceeded expectations, supporting the view of ongoing economic strength. However, non-farm payrolls and initial jobless claims data were weaker, indicating that structural pressures within the economy persist. Meanwhile, the policy stance has begun to tilt toward easing, with some Federal Reserve members already voicing support for multiple rate cuts. One point of caution is that tariff burdens continue to weigh on economic confidence and cost structures. Next week's releases of CPI, PPI, retail sales, and other core data will be pivotal in shaping both market structure and policy expectations. Looking ahead, U.S. inflation is likely to remain mildly elevated. Core CPI is expected to rise by 0.3% MOM and reach to 0.8 to 3.0% YoY. While tariffs may exert upward pressure, inflation remains within a manageable range, still above the Fed's 2% target. A mild stagflation signal that could introduce uncertainty into both sentiment and policy expectations. PPI may edge up slightly, while initial jobless claims are expected to decline to around 220,000, reflecting resilience without signs of overheating. On the consumer side, retail sales are forecast to maintain around a 0.5% MOM increase, supported by auto sales and promotional events, providing some liquidity support to the market. However, with the S&P 500 and Nasdaq already near all-time highs, any upside surprises in next week's CPI or PPI could trigger short-term volatility or even a corrective pullback. Overall assessment: the Nasdaq is likely to maintain bullish sentiment next week, but the slope of the advance may narrow further, increasing the probability of entering a slow grind higher. Narrowing volatility phase at elevated levels. From a trading strategy perspective, if prices remain above 23,589, maintain a long bias to capture the continuation of bullish momentum. If prices pull back into the 23,225 to 23,589 range, favor swing trades with quick in and out positioning, focusing on the strength of demand within this support zone. A break below 23,225 would indicate weakening bullish sentiment, warranting reduced exposure or a pause in adding new positions to guard against a second leg correction. With a concentrated macro data release schedule ahead, position management should be disciplined, avoiding aggressive additions just before key economic announcements. Okay. Want the full charts, key support and resistance zones, and my trading structure breakdown? Join my Patreon to 7 days free.